that's what we've got to be careful about. You can make big money trading these large returns, but you're taking risks that, if they go against you, could wipe you out. And first rule I learned: first thing to do is protect your capital when it comes to trading.
Welcome to Etienne with Ray Barros. We usually chat in Hong Kong in his office about trading, but this time we're on Zoom. So Ray, welcome to the podcast. Good to have you here again. Looking forward to talk trading with you again and catch up.
Good to see you.
Awesome. Good to connect. It's been a while we spoke, and I kind of want to ask you first, what's been going on since we last spoke? I think it's been at least before COVID for sure, 4 years or so.
Yeah, well, we've had quite a few changes. I think in the trading arena, there are two areas that are particularly important. Firstly, A1 is going to have a huge impact, particularly with mechanical traders. And secondly, there's been an interesting innovation in the field of psychology. You're probably aware of the wounded child idea, that what happens as children impacts us unconsciously. So we have limiting beliefs and clashing values that we bring to trading. And a guy called Dr. Russell Kennedy's come up with the idea that the way we've been treating the wounded child is actually not very helpful. We've been treating it from a mind point of view. We're trying to reframe the belief patterns that are the limiting belief patterns that are impacting us. He separated into two. He calls it, one's the anxiety, which is something we see that triggers in our brain an alarm in our body. It's a bodily response first. And if we don't deal with the bodily response first, we will continue to do what we're not supposed to do. And I've been looking into that a lot, and I find it fascinating. It certainly helps some of the students a lot. It obviously won't help everybody, but it's helped a lot of the students, help them understand why they don't do what they ought to do. Let's put it that way. You tell a guy, take a trade. This is the setup. This is where you take the trade, and he'll do exact opposite. And then he'll say, I don't know why I'm not making money. And I say, well, I do, and so on.
This is a very good point. People are sometimes wondering why they have a plan. They have a good strategy. They know they can make money with it, but in the moment in the market, they cannot make money with that strategy. So can you go more in depth into how that works and how can you apply this to trading exactly?
Yeah, well, what happens with the wounded child idea is that as children, we have a need. We have 6 human concerns, 3 which they call the survival, which is connection, love, significance, and certainty. We don't want to experience pain. We treat normal as being pleasurable, and anything outside it as being painful. That's why we're reluctant to move outside the comfort zone. So as children, we come out like that. We're born with these human traits, and then of course we get treated by our parents in different ways. And what happens is we don't get enough connection, we don't get enough love, we're not seen as significant enough, or we everything is changing for us, so we're in constant pain. We respond to that in different ways. So that's one way of looking at it. So taking it to trading, for example, let's say, for example, we treat loss as a lack of love. We unconsciously do this. So we will say we won't take a loss, because if we take a loss, we're not loved. So we're just going to hang on to losses as long as we can, which accounts for why we hang on to losses for so much. Or fear of missing out. I'm not significant enough. If I miss out on this huge trade, which is going to make me the best person in the world, I'm going to hang on to this because I know it's going to turn in my favor. These are all unconscious belief patterns that we're responding to because of how we grew up. So when it comes to Russell Kennedy, he says, be aware of the thought, that the circumstance that triggers that. And then you need to take some bodily, he goes into it, some bodily responses into that. So for example, let's say you see something, you're in a trade and you start seeing the trade go against you, rather than say, because that's what I teach, you've got a hard stop in place, you should have a soft stop, which means you exit the position in terms of time and structure. Rather than execute that, so take a quick loss, you keep, I'm going to hang on. And somewhere at the beginning of that move is a thought that triggers those actions. So if you can catch that awareness, that thought that triggers, and become aware of it, Then you take a bodily response. So, for example, you might just get up and walk out of the chair or take deep breathing. Just do something that will trigger a response that will keep you within the plan that you had. So one of the things that I teach my students is to just get up, just stand up. If you're day trading, just stand up. And that process of standing up triggers the bodily response to say, this market's coming off. Is it doing what I thought it ought not to do? If the answer is yes, I'm out of the trade, take a loss. Or yes, it's not doing what I think it ought to do, but it's not triggered my response yet. So I'm going to hang in there and wait, and so on. So that's the way that I'm looking at Russell Kennedy's ideas.
Interesting. Yeah, it's so fascinating how some traders can kind of try to do these things when they're in the trade, but then they forget about them sometimes, and then they kind of look back. People who kind of see this as, they see it like after the trade is done, like after it's too late. How can they train themselves to like do it in the moment when the trade's going on, or when they need it, like within the right moment?
It's a bit like a practice. It's a bit like, what do you do when you're playing badminton or tennis? You get a ball coming at you, for example. How do you respond to a forehand drive? You need to put it into practice so that it becomes an automatic response. And the key, as Russell says, is catching that thought. If you can catch that thought, which triggers the impulse to do something that you ought not to do, that's what you've got to catch. And once you've caught that, once you get into the practice of catching that, then everything else falls into place. It's like catching that thought that's difficult, that bodily response that says, I'm feeling, we tend to feel anxious. We tend to, my heart starts thumping, I breathe more quickly, or whatever it might be. We all have a bodily response to the alarm that gets triggered in our brain. And if we can identify it, and that's the hard part, but if we can identify it, then the rest tends to become a lot easier. So in answer to your question is, the first thing I would do is try and identify what is my bodily response that tells me I'm now about to do the wrong thing. And that's what I've been trying to get across to my students.
You've been teaching your strategies to people for multiple years now, and I'm sure you've seen this like over and over again, but there are people who need the strategies. There are people who need the mindset more than the strategies. How do you kind of define what you got to work on? How do people know if they have to work on the strategy or the mindset more in trading?
Well, I think if you're going to, we had this discussion once before when we met. My view is that we need mind, money, and method. We need the multiplication sign in between each of those things. So we need a strategy, we need a mindset, we need a money management, our risk management. You can't do one without the other. They all three are absolutely necessary. So on a strategy, you got to know you have a positive expectancy, whether you do it by back testing or forward testing or whatever. You need to have some sign that strategy actually works. And a lot of people take strategies, they create strategies of their own, and they have no idea whether or not it's got a positive expectancy. So they need to either back test it or forward test it, whatever it is, to know that they've got a certain amount of positive expectancy. Then they need to have their mindset. They need to be able to execute those rules consistently. And finally, of course, they've got to have their risk management, their money management rules in place as well. So those three things come together. I don't think it's a question of which comes first. I think they all have to be there, unfortunately. And that's what makes trading difficult.
How does a trader know what exactly to work on? Because sometimes they could confuse strategy for mindset or mindset for strategy.
I think this is where your process and your journals come in, right? So if you have a strategy that says, okay, I'm going to analyze the market, I'm going to go with the trend, I'm going to identify the trend, I'm going to go with it, and these are the strategies I'm going to use in an uptrend, these are the strategies I'm going to use in a downtrend, these are the strategies I'm going to use in a sideways trend, and they're very clear about the rules relating to that strategy. So by looking at their journal, they'll be able to tell whether or not they've been executing the rules. It's as simple as that, right? And the same with the money management, which is the same thing as your method in terms of setting out the rules clearly. So for your position sizing, I will not risk more than X%, whatever it might be. So when it comes down to looking at your journal, you can look at your journal and look at your equity journal, look at psych journal and say, yeah, I can see where I did wrong. In this case, I actually should have waited for the market to come into my zone, but I didn't do that. I took it early because I thought it wasn't going to come down. Or I should have waited for my entry trigger and I didn't wait, whatever it might be. The next question, I think, is the critical one, which is I don't have an answer to, and I think maybe Russell Kennedy might. Why don't we keep journals? I mean, this is the
tough questions. Yeah.
Yeah, it's like I always tell my students, guys, look, take a trade, put it into your equity journal, and you should be preparing it before the trade. You should have your psych journal done. Take the trade, put it into your journal. That, to me, is the most difficult part. And again, this is where Russell Kennedy's coming. Somehow, when we relieve the pain, it's as if keeping a journal relieves the pain. And was one guy said to me, what if I keep a journal? I do everything you tell me, and I still don't succeed. What kind of dummy does that make me? I said, look, think of it the other way around. Keep the journal, and you may not be a dummy, right? See what happens. But that I think is the key question. Do you keep a journal? If you don't keep journals, then you're really you're going to find it very difficult to succeed, because journals, I think, are the foundation of improvement and success.
How do you keep your journal? I know you've maybe touched on this before a few years back, but has it changed, or is it the same thing?
No, it's pretty much the same thing. I still keep I will keep a snapshot of my preparation, if I can put it that way, and I put that into Evernote. I've got a journal in Evernote which is pre-preparation trades. Then I've got a section and a folder in Evernote which says trading, and then post trading. So there are 3 trades that I find in Evernote, and they've improved also with their search facilities, and you can now create backlinks which are very helpful. So it's still creating snapshots, putting it into Evernote, and then writing whatever I might write down if I find particularly significant. The Evernote searching is now very useful because you can actually write down tags and so on that will identify an area that you might be concerned about. So, for example, an area that says, "Oh, this is a trade where I'm going down," is where there are reports coming out. So you can create a tag which says "report trade." So you can then look up all your report trades and see how they go. So I found the Evernote, and you can get it for free. The good thing about Evernote is a lot of it's free. You can have a free version. I get the middle one, and you can do a lot with it. I like Evernote because it allows me to do searches, and if you keep it properly, it allows you to find things very easily.
So in the same notebook, you would have the pre-trade and then the post-trade, and then is that kind of
Yeah, I have 3 folders. There are you in Evernote you create folders, right? So you create a folder I call a pre-trade folder, and then I call it a post-trade, during trade folder, and a review folder. And within those folders, I break them down to assets. So I've got currencies, indices, gold. They're the 3 asset classes that I trade. So I keep within the folder of pre-trade, there are those 3 asset classes and so on. And then within every time I make a journal note, I will have a tag. I have a series of tags, like if I do something wrong, if I've done it absolutely right, I might write down good trade. I've got a tag called good trade. So if I want to find all my good trades, I just search for the filter good trades, and they all come up. Or broke rule number 10. I can find broke rule number, and then it all comes up for that particular number. So I find Evernote incredibly useful.
It's also a good way to keep a more like quality-based journal instead of like just the equity curve and the stats and the entry price and the exit price and the time and stuff. It's a good way to kind of look at the quality more than just the trades by themselves. So it's definitely good way to do that. Do you keep more detailed stats in a different way, or like you have like a place to kind of keep a log, or more sort of way of your trades?
No, I call Evernote's my psych journal. I keep my qualitative journal. My Edgewonk is my quantitative journal, and that your stats and so on. The good thing about Edgewonk is it actually allows me to put some qualitative stuff in it, which allows me then to link it to Evernote. And Edgewonk also has a good search function. That's a bit expensive. It's about for most people, I suppose, for some retail trades, it's about $166 a year, but it's online, and it's I find it useful.
Yeah, it's definitely good. Back when we talk, H1 was only on the computer, not online, so it makes it a lot easier to kind of travel or be in different places and have a journal. So it's pretty cool. Very good update that they have. That's good.
Yes, it is.
When it comes to the other thing you mentioned, you talked about A1. Can you tell us more about kind of how that works out and what do you think that will change the trading industry or the mechanical trading?
This is still in the very early stages. I got involved with A1 because I'm a lousy marketer, especially when it comes to writing copy. And A1 attracted me, and I started finding that it really helped. If A1, what I found, and I could be wrong, as I said, I'm an amateur in this regard. What I found about A1 was the quality of the questions you ask it, the priming that you ask it makes a lot of difference to what and kind of answers you get. The better the priming, the better the answers. And I can see there are a lot of courses now talking about A1. I cheat a little bit. I get a thing called Jasper, Jasper. And what that allows me to do is write down what I want to discover as far as writing is concerned. And then it allows me to enhance the prompt before I send it off to A1, to ChatGPT. And that makes a lot of difference. So I don't have to spend too much time learning how to use it. If I didn't use Jasper, I would have to spend a lot of time getting the quality prompts. You can see the difference between what I write and what the enhanced prompt comes up with. Very, it develops insights that I would not have seen it, but I agree with, and then it sends it off to get it done. The way I see this, and I found someone who's trying to help me now with this, is I've separated my trading into two. I think we spoke about this last time. The way I see it is that I want to identify the trend of the time frame I'm trading. Is it likely to continue or change? And then I look for a zone once I've got a strategy, because that's what if your trend is up and it's likely to continue going up, I'm looking to be a buyer. If I'm looking to be a buyer, where would I be looking to take a zone, basically? Where would I be looking to take the trade? That's a discretionary aspect. And then I come into the mechanical side, which is the execution of that trade. The back testing that we do nowadays on the mechanical side is very good. It identifies whether or not you have positive expectancy, what sort of consecutive losses you can accept, what sort of position sizing you should take, and so on. The problem with BIN has been the discretionary side. And I think that A1 will allow us to do that, because for me, the most important thing in a trend, whether it's up, down, or sideways, is easy because I use swing charts. I use my Barros swing charts. But the question then becomes, is it likely to continue or change? That's always been the hard part. That's where the discretion and experience comes in. But there are 4 questions I asked there: price, structure, time, and momentum. And I think that if you program A1 will be able to answer that question reasonably better than we've been able to do in the past. And that's what we're trying to do now.
Yeah, I feel like it's definitely a long-term game. Might not be able to do it now, like at this moment, but in the future, long-term, with some new tools coming up, it could be a good way to do it for sure. But it will take time.
Yeah, it'll come. And A1 has made a huge change. I mean, to the marketing side, you just look at the marketing side. It's just, we started off with copywriting, and now we're drawing videos. We're doing, people who draw graphs, not graphs, but diagrams. And it's just, every time you pick up the news, something about in my emails, something new about A1. A1 is now doing this. A1 is now doing this. And I'm thinking, this is the start of the internet all over again. I don't know if you're young enough to remember that, but when the internet first started, it was just, okay, but it was exciting. Now A1, I think, we're at that point. A1 is going to change the world we live.
Yeah, definitely a lot we can do there. And I think that people should learn it. At the same time, people won't have to fall into thinking it's the only thing now that they should focus on. Because trying to kind of spend all your time on AI or A1 now is maybe not the right way to do it. But kind of trying to look into it slowly and kind of discovering it could be a good way to do things for the long term, perhaps.
I agree, Etienne. Absolutely.
In terms of trading in the markets, has anything changed? Is the market the same? Is it different? Do you have different things that you see now in the market? Especially since we have COVID and the Ukraine war, different things. Or is it the same thing as it was before for you?
Well, the markets for me have been relatively quiet this year. I was short the indices very early in the year, and then I've been out of the market. I've only just gone long the S&Ps. I think we're in the market. If you dig out an old monthly chart of the Dow going back 1967 to 1982, I think we're going to be in that period where we're in the process of forming the highs and lows for a major sideways market. And if we look at it, we started this bull run from 1940, and I think we're now coming to the end of it. So, but that doesn't necessarily mean we're going to have a bear market, but it can mean, and I think that's what we're going to be seeing, that as far as the indices are concerned, we're going to be in a massive sideways market. We're just in the process of forming it now. That's one thing. So currencies, the tens, and it goes up and down, but the relationship goes up and down. There's an inverse relationship between the US dollar and the indices. Gold is the question that I have in my mind is, I don't think this inflation is going away anytime soon. I think, as I said, we're back into the 67, 81 era where, if you remember, well, maybe you don't remember, but Arthur Burns was the Federal chief at that time. And every time inflation went up, he'd raise his rates. And every time it would look as though it was coming off a little bit, he'd lower them. And if you look at your inflation chart, inflation just kept creeping up and up and up until Volcker was finally appointed because it had gone through the roof. I think Powell has seen the danger. The question is whether or not the central banks will have the courage to hold on to the high rates that will cause a recession. I don't think we have any choice. It's not a question if we're going to have a recession. It's a question of how deep a recession we're going to have. And I'm a bit, maybe it's my age, but I'm a bit pessimistic given the amount of money that we've been pumping into the economy since COVID started. We'd started even before then, but we pumped it even more because at that stage, if you recall, what happened was, I belong to the Austrian School of Economics, which believes that if you pump money into the economy, that's what causes inflation, because eventually when the amount of money exceeds the amount of goods and services, inflation has to happen. What the Federal Reserve and a lot of the major central banks found was that if they offer interest rates to the banks, they could keep inflation down because the money wouldn't go out to Main Street. It was going into the reserves until COVID. And then we had the financial crisis. We pumped the money in and it was fine. Money was going into the banks. The banks had put it into the stock market or whatever, and we wasn't getting into Main Street. But COVID came along and spoiled all that. And it still hasn't finished its impact. So money is still going into the economy and inflation will still keep going up and they have to keep raising rates. That's going to be the key. And if they don't, then inflation will run out of control. So we're going to have a recession because as you raise rates, eventually, according to Austrian economics, the only way to solve the problem is to have a recession so that you line up the money supply with your goods and services again. The question is what kind of recession are we going to have? So that I don't know. We'll have to see what happens. But trading wise, I think it's going to be difficult. I think it's going to be difficult for the next few years. The days of where we were having a nice strong uptrends in the stock indices, we've got some strong trends in the currencies. That I think is probably over.
What does a recession means for the currencies? Because we know the stock market will go down. We know it's probably going to crash. But what about currencies? Is it going to be more clear, or what can we expect for currencies in a recession?
I don't know. I think you're going to have individual currencies, I suppose. The question is going to be if the dollar connection continues, then whenever the stock market's going up, the US dollar will be down, and when the stock market's going down, the US dollar will be up. So US based currencies crosses will be probably going sideways. Now, I don't trade the other crosses, the euro yen, for example, that sort of thing. So I'm not too sure what that means for it. But as far as my instruments are concerned, I'm seeing sideways trading to be the dominant strategy over at least the next 3 to 4 years.
Interesting. And what's on the pairs you're looking at, or the pairs you're trading mostly?
Well, I tend to trade. I trade the sterling, the euro, the Aussie, CAD, and New Zealand. They're the five that I tend to focus on.
Interesting. Is there a reason for it, or is it because these are pairs you've been kind of sticking to?
Just the pairs that I fell into, and I traded the crosses for a while, but I found that the crosses, when I started to trade the currencies, weren't really they were moving in tight ranges. It just happened at this time, so I shifted to these ones, and I've stayed with them. I just haven't bothered changing.
A lot of new traders are kind of thinking about which pairs they should focus on trading first and which pairs they should start with. Do you have any recommendations on like how to find the right pairs to trade with? Is it based on like what charts they like, or is it based on some more volatile pairs, or what do you recommend?
Yeah, well, what I do is that I suggest to the students that they look to buy the strong pairs and sell the weaker. So they need some sort of relative strength indicator. I use Optima, and they've got that. So that's the first thing I would do, and then I would look within that structure. So let's say, for example, you find the euro yen, euro sterling. Euro yen is going up. Euro sterling is the weakest, and euro sterling is the strongest. Then within those two pairs, do you find the rules that will get you to take a trade? So you may find you might euro yen may be the strongest, but you may not, your system or your rules that you're using to trade may not fit that instrument at this time. So that means you don't have a trade. So you're looking for trade and a currency that's strong based on relative strength to buy, and then you're looking at your rules to make sure that your rules fit that instrument at the moment. Because the last thing you want is to buy something that the rules don't fit.
One of the big changes of the past few years is these prop firms. I'm sure you've seen like new prop firms offering capital to traders, and that kind of is similar to, I guess, starting a fund, or that we've done it in the past, which is like having a hedge fund. Similar, but not too much. So, what's your thoughts on these prop firms and these companies offering capital for traders?
Yeah, I don't know. They never got involved with them. So I'm speaking from secondhand experience, and I'm always a bit careful about that. What I've felt about the prop firms is that you get some really genuine ones. If you get a genuine prop firm, that's fine. They'll come in, they'll teach you what they want how they want you to trade. You know, the system that they're going to use. You got to keep to it, and if you show promise, they will fund you. But a lot of the ones that advertise as prop firms are just out there to get your money, to pay them to teach you how to trade, and they'll fund you, but that funding never really appears, if I can put it that way. So I guess you have to be a bit careful. As I said, it's not an area I'm very familiar with because I haven't got myself involved in that.
Do you recommend people to go and start hedge funds, or at least start private fund these days, or is it a bit too complex for people to do that?
I think there are two things that are happening. I think you can, in most countries, you can start what we call limited partnership hedge funds. If you're approaching people you form a limited partnership, you don't need a license. So generally, in most of the Western countries anyway, because there's nothing stopping you from creating partnerships with people that you're familiar with. If you go out and try and raise money from the general public, then you need to get a license. Getting a license is very expensive, and it's a very difficult process, if I can put it that way. And secondly, the kind of client you're going to get from the public is very different from the limited partnership hedge fund. With my limited partnership hedge funds, I could choose the people I wanted. They fit my personality. They would fit my style of trading, if you will, whatever it might be. You don't have that when you're dealing with the public. So you've got to be very clear about what you're trying to establish and with whom. So with me, it was always limited partnership hedge fund. I've got some friends who started public funds that did reasonably well. And remember that your public funds, the first sign of trouble, they're going to be running. Generally, that's what I was told by my friends. So, and you can see this, I had a period where for 3 years, I didn't make any money. I think that was my maximum loss period. I dropped about 27% within that 3-year period, and I lost one client. If I did that with a public fund, I would probably lose 30% of my clients. It's a whole different ball game. So you got to decide. I think hedge funds raising money is now more difficult. I think we're just in a more difficult environment. It's easier to raise funds when the markets are easy to trade and profits are relatively easy to come by. You've seen hedge funds go broke. I mean, we've seen hedge fund after fund close recently. That's one thing. And you see it to a certain extent. We see the same thing in the educational field. I think education now as a business is much harder than it was when I first started. It's people get a lot of freebies from the net and they think that, okay, all I've got to do is I go to the net and I'll be right. And my answer to that always is to the guys. I said to one guy yesterday, I said, look, you want to go to the net, that's fine. If you're a surgeon, my brother's a doctor, so that's where I got it from. I said to him, if you want, and he's a friend of my brother's, if you want to be a doctor and you think you can go to the net and get the education you need to be a doctor, go right ahead. And he stumbled. He said a few Australian. He said a few F words as far as Australians are concerned. And I said, well, let me repeat that back to you. I think trading is a harder profession than medicine. And yet you want to go to the net to get your education for trading, but not for medicine. Does that make a lot of sense? And at that point, the conversation on Zoom ended. So I'm not sure how that went. But the point I'm making is that as far as money is raising is concerned, students are concerned, we're in a difficult period.
That's why it's fun to talk with people like you also, is because we get a better perspective on what kind of work is needed for trading and also what kind of expectations you can have for the returns. And people expect that they will just get profitable, make money forever on after. And that just doesn't happen very often. So
yeah, I've been fairly consistent. I mean, last year was okay. I did just that. I've been around 20-25% per annum over the years. You get your losses, of course. Last year was a little bit under 19 point something. And I think this year we're going to be well under. Because I tend to be a trend trader. You look for trends to get into. So I'm not very comfortable in sideways congestion markets. And I tend not to trade. So I'm up about 3% for the year. I could be down 3% for the year. Just we're picking a time when we're discussing, but it could have just as easily been the reverse. So I think at this stage, if you are a reversion to mean, you're comfortable trading a sideways market, I think you'll do very well. I think so we'll see what happens.
As of now, it's about like the new traders hearing 5% a year or something might be scared, and that's why there's so much people promoting bigger returns than that, which is probably not fair at all. But at the time, it's good to have people like you who know what trading is really all about, who've been there and who kind of know the expectations behind it also. So it's good to kind of connect and see what you're after in that case.
As I said, it really just depends upon your style of trading. And my style of trading doesn't suit the current market. So it's not going to. But, going back to what you're going to say, I ran the private limited hedge fund from 1990 to 2010, I think it was. I had 1 year where I had a triple digit, and that was the last year. Generally, it was always around the 20. As I said, I had a 27% drawdown over a 3-year period. And so, but generally, and on average, it was, I think, 22, 23%. And that's what most funds do. I mean, some of the funds may do better than that in any one given year. Very few funds but there are very few funds will be in the 30-40% mark. I don't know of a single fund that does consistently 60-70% per annum. I think if he did that, he would get so much money, he wouldn't know what to do with it. But, when you see these things that come out, and I'm not saying that they're false, but it's the focus. They make 70% or 40% in 2 months. Okay, that's true. But what do they do by the end of the year? And what do they do over 5 years? What do they do over 10 years? That's what you've got to look at. Something that works now, the risks that just to give you an example of what I'm talking about. I have a very good friend, and he's a, very hard worker. And he came to me and he said, I'm doing X, Y, Z, and I have turned 78% in 2 months. And I said to him, okay, let's see what you've been doing. And we looked at that and I said, look, you're taking very big risk. Your position sizing, if it goes against you, you're going to wipe this account out. He said, no, I'm now taken trading to the next level. About 2 weeks after we had that, he started the down move, and within, I can't remember the time now, I think it took 3 months to create that money. In about a month, he lost it all plus. I won't mention how much he lost, but he lost it all plus. So that's what we've got to be careful about. You can make big money trading these large returns, but you're taking risks that if they go against you, could wipe you out. And first rule I learned: first thing to do is protect your capital when it comes to trading.
It's tough to tell a trader that they're risking too much. It's very hard to make them understand that. And even if you try, they will say, "Oh, I'll just try it out," and then they will lose, rather than listen to someone telling them that they risk too much, that they're being unrealistic. So it's very hard to do that. So
I don't disagree. I think it's one of the hardest things they have to learn.
I want to respect your time, and this has been really good advice so far, really good things people can apply, but I want to respect your time here. So where can people connect with you or kind of see what you're doing and learn from you in the future if they want to connect and reach out after the podcast?
Yeah, absolutely. Anytime, drop me a line, whatever you want. One of the things you're going to find is if we do this another 7 years down the track, we do another podcast. My hearing is getting worse and worse. So I may have to learn to read lips, but feel free to drop me a line anytime.
Awesome. Yeah. We have a few other interviews also on the channel so that people can watch if they want to watch them. I'll leave the link below so you can also catch up with these old interviews, which are, by the way, really good. I missed this time in Hong Kong. We sit together and talk trading. So we definitely have to do this again in the future. That would be pretty cool.
Sounds good.
So thank you. I appreciate it. And I'll let you go. And thank you for being here and giving the advice and talking to people. I appreciate it a lot.
Thank you. Take care. Bye-bye.